So in 2024, Anders, do you think, and Sarah, do you think we have achieved the soft landing, the nirvana that the Fed's always talked about?
Yeah, and short answer is I would say yes.
Really?
I think if I look back to 2024, I would say probably the biggest surprise that I would see is that the U.S. economy has held up so incredibly well. I mean, if we were sitting here a year ago, you know, like the Fed was expecting sort of a 1.4% GDP for 2024. We well achieved that and exceeded that. There were plenty of economists calling for a potential hard landing, a recession of some kind, and we obviously avoided that. So, yeah, I would say we're in a soft landing. Possibly there's no landing kind of type scenario as well, but certainly I would say the U.S. economy has well exceeded expectations this year.
Yeah.
And I'd agree with that, where we're pretty close in terms of you've continued to see the economy grow. Inflation has improved a lot, but I would say we haven't landed quite yet. You know, if you look at inflation, it's still above the Fed's target. It's been moving sideways since. So I think we've made a lot of inroads and I think gotten to a much better place with a lot less pain than I think was initially feared when we had inflation above 9% and the Fed was raising rates at 75 basis points a meeting. But now I think at least with the Fed easing policy to some extent, I think really what's been the biggest risk hanging over the U.S. economy has been removed as the Fed's eased.
To stay with you on that, is the inflation, are we just now seeing the effects of this long, I know inflation has dropped to that 9% print that everyone was stunned, maybe not stunned by, but this long effect, the long tail on inflation, is that what we're seeing right now?
I think we're seeing part of that, but at the same time, we've seen goods inflation. It's the deflation that we've seen. It's really petered out, so you're not seeing as much downward pressure as that. Where we had a lot of low-hanging fruit. If you think about, okay, well, we saw oil prices and agricultural commodities spike in 2022 with the Russian invasion of Ukraine. So as those prices came down, that made for some pretty quick deceleration in inflation. But now this is a harder part of the inflation battle. We're still seeing some progress on services, but it's very slow. So we're still dealing with inflation.
Are we seeing the effect of inflation on consumer spending in a big way?
Well, it depends on where you look. I mean, it's been a softest landing, and it's been softer for some than others. And if you earn the median income or less, you're getting squeezed because food prices are up, and they're 26% higher than they were in February of 2020. And if you're trading down and you're buying more ground beef or you're buying chicken or you're buying pasta, prices are up 44%. And so that's really squeezed the life out of half the consumers in America. Whereas if you're on the upper end and you own your own home and you've got a 3% mortgage, you've got plenty of discretionary income and you're out traveling and having a great time.
So who wins that battle? The latter or the former? Who drives more of that consumer spending? The smaller?
Well, I want to go back to the original question in terms of a soft landing. Okay, I mean, we talk about the Fed dual mandate. Okay,
Yep.
And they're not there yet, and they're not close, and they've stalled. And particularly if you look at the core CPI, which is less food and energy, that has definitely stalled above 3%.
So is this a new normal on inflation?
No, it shouldn't be. But let's ask ourselves a question. Why did the Fed scramble to reduce rates in the second half of this year, 24, all right, while we still had pretty significant and sticky core price inflation, all right? And the reason is the Fed is just like Silicon Valley Bank. They've got a mismatch between their asset yields and their liabilities, the yields, okay? They're paying more to banks for the deposits, reserve deposits, than they're receiving from the treasuries they own. For the first time in history, for the last 2 years, the Fed has lost money. Normally, the Fed makes money and remits to the Treasury any profit they make. And typically, that's 70 to 100 bill a year.
When was the last time that happened?
September of 22. They've been losing money since then. And in fact, over the past 2 years and change, they've lost over $200 billion, which they are borrowing from the Treasury with IOUs. And so if you ask me, one of the principal motives that why the Fed is reducing interest rates has less to do with inflation and soft landing than it has to do with the fact they're continuing to lose money.
but let's-
$10 billion a month.
Yeah.
Let's not forget about the labor market, though. So that's the other side of its mandate.
How
and I
can
think
you
that was a
argue
big
with
reason.
200 and something thousand jobs being created last month?
You can look at the quarterly census of employment and wages, which shows it's about half the pace, and we've seen a much more market slowdown. And I think we've seen the unemployment rate move up, where I think when the Fed's just looking at its two core mandates, yes, we've seen a lot of improvement on inflation, not there yet, but I think a lot of what motivated the beginning of the cutting cycle was that you're starting to see, I think, some more cracks in the labor market,
I'm just
and they
skeptical.
don't want to see that.